The Bank of Thailand's decision to raise its policy interest rate yesterday may have dismayed business operators, individual borrowers, and politicians. However, on the brighter side, it is a kind of assurance that Thailand's economy is doing well enough to weather a perfect storm brewing over the US, European, and Japanese skies. Signs of recession in advanced economies are everywhere, including Moody's first rating downgrade for Japan since 2002. Mortgage applications in the United States last week slumped to the lowest level since December 1996. German business confidence fell sharply in July, and expectations for the coming 6 months fell as well, the latest in a series of bleak indicators for the top Eurozone economy. In June, Eurozone industrial orders suffered a more than forecast 0.7% month-on-month drop, adding to economists' apprehensions that growth in the zone had lost momentum after a solid start. The latest sign of significant slowdown in the group of three, the US, Europe, and Japan, was Moody's decision to downgrade Japan's rating by one notch to AA3, blaming a build-up for borrowing and revolving door politics for delaying efforts to cut the world's largest debt. Speculation is running high that the U.S. Federal Reserve will launch the third round of quantitative easing, which might not avert the crisis. But that would show investors worldwide its readiness to act in salvaging confidence. Despite the perfect storm brewing, Thailand's policy rate was raised yesterday by 25 basis points to 3.5% as expected. The Monetary Policy Committee repeated its message that, despite partial weight on exports, the Thai economy would be resilient to global jitters. Thanks to export diversification to new markets, domestic consumption and investment, improved confidence and fiscal stimulus. It seems the rate hike will not stop there. Economists at the HSBC and Siam Commercial Bank, as well as those covered by Reuters poll, expect the central bank to increase the rate again in the remaining meetings between October the 19th to November the 30th this year. They agreed that the only thing that would persuade the central bank not to proceed with rate normalization was heightened economy risks in the G3 countries in the months to come and ramifications on the global economy. Then, many more houses would join Morgan Stanley in painting a negative outlook for the globe. Higher interest rates are undesirable, but lower rates may not be desirable if they come on the heels of heightened external risks. Achara Debunmi, The Nation Analysis for ASEAN TV.